So don't be surprised इसका इतना वैल्यू हो गया, जोमेटो का 1,40,000 हो गया, पर मिलेंगे 5 साल बाद, देखेंगे.
On 21st of July 2021, Zomato was listed on Indian stock market, a loss-making company which was being sold as a dream to retail investors. But Zomato gave more than 100% returns in the first 3 months of its listing. And on 16th November 2021, Zomato stock hit its lifetime high price of 169 rupees, delivering more than 220% returns from its issue price of 76 rupees. Retail investors were making free money in Zomato and they were very happy. But very soon the Zomato ecstasy became a nightmare for retail investors because the stock started crashing. So now the question arises, was the big bull Mr. Rakesh Jhunjhunwala right about Zomato? Is Zomato stepping towards its bankruptcy? Because this Indian startup, which was founded in 2008, delivers 4,000 food orders per minute. Their revenue is increasing daily, but some severe losses follow this growth of Zomato. And these losses are so significant that they can potentially make Zomato bankrupt. And because of these reasons, many of you might think that Zomato is a valuation scam, but still it also has the potential to become the next Amazon of India. How? Let's find out in this video. The food delivery business is not new in India. Around 125 years ago, while under British rule, India developed the Dabbawala meal delivery system in Mumbai. In response to the increasing number of city workers, this meal delivery system relied on delivery men called Dabbawalas. But the online food delivery business actually started in 2012 when 3 friends, Ralph, Rohit Chaddah and Ben, founded a company called Foodpanda, which was once valued at $3 billion, operated in 45 countries and delivered more than 2 lakh food orders per day. And this glorious company today is just another case study that teaches us how food delivery companies can go bankrupt. And this company, which was once valued more than 21,000 crores, was bought by Ola in 2017 for only 250 crores.
Cab-hailing app Ola is all set to enter the food delivery space. The company has acquired Foodpanda's India business. Ola has committed to invest $200 million.
And Ola even invested 500 crores in reviving the business, but nothing worked. The losses kept on increasing. And finally, in 2019, Ola suspended Foodpanda's food delivery business. So, the online food delivery business never actually made money. And now the real question is, will the history repeat itself in case of Zomato? In order to understand, let's start with the business of Zomato. So, Zomato is an Indian restaurant search, discovery and online food delivery service. And this food tech unicorn was founded by Deepinder Goyal and Pankaj Chaddah in 2008. And it currently operates in more than 10,000 cities in 25 countries, including the US, India, Australia, Brazil, New Zealand, Singapore, and in Middle East, Qatar. Today, Zomato has 6 major income sources. The first income source is restaurant listing and advertising was one of the first source of revenue for Zomato, and it remains to be a significant contributor even today. The company charges for sponsored listing, allowing restaurants to increase their visibility on Zomato app and Zomato website. And Zomato also offers local advertising for restaurants in a much same way as Google does. And second revenue source for the company is delivery fees, where Zomato offers food delivery services and collects delivery fees from the users and also earns a commission from the restaurants processing the order. This commission is then split between the Zomato and the delivery boy. And the third source of revenue for Zomato is loyalty programs, where Zomato offers various loyalty programs that give exclusive discounts to its members. And the fourth source of revenue is ticket sales for special events, where Zomato sells tickets to festivals and events like Valentine's Day and New Year events. And these ticket sales earn commission to Zomato, which they collect from the restaurant owners for sending people to their restaurants on these events and festivals. Each event is promoted on Zomato app, earning the company another source of advertising revenue. The fifth source of revenue for Zomato is Zomaland, which is a food and entertainment carnival that brings together some of the top eaters, musicians, DJs, comedians, and interactive installations and carnival games under one roof. So it is like an offline version of its Zomato collections, where it curates and brings the best restaurants in the city together. And the sixth source of revenue for Zomato is consulting. There was a time when Zomato started, they used to go and explain their plans to restaurant owners and ask them to list their restaurant on their app. But today, restaurants come to Zomato for their consulting services. With access to extensive amount of restaurants and consumer behavior data, Zomato also offer a consulting service. this includes advice regarding the demand level of new eaters in a specific area and also the pre-existing competition levels. And one of the competencies of Zomato is its large amount of database of restaurants and customers and its analytical tools, because the brand is aware of food preferences of specific area and their ordering pattern or behavior through its database, because of which food startups who are looking to enter those market areas seek consultancy services of Zomato for database, and Zomato charges a fixed price for the same. Zomato also offers white label services where it offers to food organizations so that they can develop a customized food delivery app for them. And this app development also contributes to the revenue generation of Zomato. And then the sixth source of revenue for Zomato is Hyperpure. Zomato has launched an initiative called Hyperpure in its sustainability business segment. And under Hyperpure, Zomato delivers clean and fresh ingredients to its partner restaurants and emphasizes on improving the quality of ingredients used by the partner restaurants. In the first half of 2020, that is from April to September 2019, Zomato successfully served 2,200 restaurants in Delhi and Bangalore and distributed 65,000 plus orders of these ingredients. So in a way, you can say that Hyperpure is a B2B, that means business to business delivery system for restaurants in India, where Zomato will work as a supply chain for restaurants by delivering them fresh, hygienic and quality ingredients and supplies directly from the farmers, mills and producers. In this way, Zomato will help the restaurants to make their supply chains more effective and predictable, at the same time improving the overall quality of the food being served at those restaurants. And Hyperpure is a very promising business for Zomato, and it has a lot of growth potential in it, because it's a win-win business model. Because if Zomato can help restaurants become better and sell more quality food, then more people are going to order food from this restaurant from Zomato app, which will help Zomato's food delivery business grow. And at the same time, for getting this help from Zomato, restaurants will also be willing to pay big amount of fees or service charge. So by this way, restaurants can also become better and Zomato can also earn more money. And that's why it's a win-win business model, which has a great potential to grow. And now, after understanding the business of Zomato, let's try to understand the challenges for Zomato. So the first challenge is shifting of customer preferences. The ultimate aim of any food delivery service would be to grow its market share by offering the best possible value to the customers at the lowest possible cost. Food delivery market players have elevated the marketing game to such a level that customers are spoiled for choice even as competition grows. And this is making the customer base unstable and affecting the brand loyalty. Because if you see, in the year 2021, Swiggy and Zomato shared roughly 13% of the same user base. And in food delivery business, loyalty of the customers is a big issue, because ultimately the crowd will follow the discounts, because customers compare the price of same order on Swiggy and Zomato and their order completion depends on who is giving more discounts. And because of this, customer loyalty is a big issue for Zomato. And to increase customer loyalty, Zomato tried loyalty programs like Zomato Gold, Zomato Plus, etc., where Zomato thought if a customer bought their subscription, then they would only order from Zomato. And this idea was very similar to Amazon's Prime membership, where people who buy Prime membership are inclined to order from Amazon, which in turn increases the loyalty towards Amazon. But this idea didn't work for Zomato, and all the subscription plans were a big failure for Zomato. And then the second challenge for Zomato is its increasing losses, where earlier we had seen that how much losses Zomato is making from 2019 till date. So now let's have a look at what Zomato has done to reduce its losses from the time it has listed in the stock market. So in this timeline, if you notice, Zomato has already exited from 4 countries, which are the US, UK, Singapore and Lebanon. And the main reason for exit being Zomato failed to gain market share in developed economies like US and UK, which is a big failure for the company. And generally, acquisitions help a company to expand, but Zomato is overdoing when it comes to acquisition, such as acquiring Fitso and investing in QFit, because these brands deal in healthcare, which has nothing to do with their food business. And because of such decisions, it is very evident that Zomato has not been smart regarding decisions around allocating capital. And when it comes to capital allocation, Zomato was expected to set an example for other startups planning to list in the stock market, but instead Zomato became an example of what exactly not to do while allocating capital. And Zomato recently also acquired Blinkit for around 4,447 crores to enter in quick commerce business. And now this acquisition is also very risky for 2 reasons. Blinkit is a loss-making startup, although the firm's average order value is about 509 rupees, which is 28% higher than Zomato's. But Blinkit is still losing 84 rupees per order. So it is very challenging for Zomato to make Blinkit profitable, which is a risky bet because Zomato itself is a cash-burning and a loss-making company. And the second reason which makes this acquisition very risky is huge investment in Blinkit. On this acquisition, Kotak Institutional Equity said, "We believe Blinkit will require investments beyond the 400 million envisaged by Zomato given rising competitive intensity." And Kotak Institutional Equities seem to be very right about it because there are tough players in competition like Dunzo, which is backed by Reliance, Super Daily, which is backed by Swiggy, and Zepto. And all these companies are well funded and are willing to burn cash to kill the competition and acquire as many customers as possible through discounts and offers. And now, after making huge investments for acquiring Blinkit, Zomato has no other option and it has to burn cash on Blinkit to survive and stay in the game of quick commerce market. And that is the reason why Kotak Institutional Equities has said that Zomato needs an investment beyond $400 million to run Blinkit. So now the question comes, can Zomato plan to become profitable? So the answer is no one can predict Zomato's state next year. The experience of 2021 and 22 has not convinced many investors or analysts that things will change dramatically. After all, the challenges of food delivery business will not be solved overnight and the competition in quick commerce is also set to intensify. Competition in the food delivery business was about who will burn more cash to attract customers by giving discounts. That is why most of the companies like Uber Eats exited the Indian market and now there are only two remaining players, which is Swiggy and Zomato. And out of these two companies, the company who manages to become profitable will be the one who can keep burning cash to the very end. And at the same time, the other company runs out of cash and goes bankrupt. So it can be either Swiggy who can become profitable and Zomato will go bankrupt, or it can be Zomato will become profitable and Swiggy will go bankrupt. And some might say that big investors back both these companies, so they both have a lot of money to give discounts. You might have seen in an interview, Goyal, the chief financial officer of Swiggy, said that we have 1.6 billion in bank. And even then, they can't stop giving discounts and continue to burn cash because if they do stop, then they will provide space for another player to enter the market. Because right now, no other player dares to enter this space because they know that they can't burn cash as much as Swiggy and Zomato does. And if one day, if Swiggy and Zomato comes to a mutual agreement not to burn cash on discounts, then on that day, many other players will enter the food delivery business and offer discounts to take customers from Zomato and Swiggy. So even if Zomato and Swiggy comes to a mutual agreement, they still can't stop burning cash. So right now, this is the biggest challenge which Zomato is facing to become profitable. So now an automatic question comes to mind that if there are so many challenges for Zomato to become profitable, then is it possible that Zomato's valuation is a scam? So to answer this question, Zomato is still a startup and a fairly valued company in the private equity market. But when it comes to stock market, these valuations look like a scam. So how do valuations work in the stock market and private equity market? If you have seen Shark Tank India, then you must know Anupam Mittal, founder of Shaadi.com. He is an active angel investor. He invested in many early age startups like Ola and Rapido. Anupam Mittal is currently invested in more than 200 startups. But in India, almost 90% of the startups fail within 5 years of their inception. And according to this probability, almost 90% of the Mittal's investment should fail. But still, the remaining 10% will make him a fortune. So the point I'm trying to make here is that these angel investors and venture capitalists invest in hundreds of companies and try to win the game by the number of investments. And that is the reason why loss-making startups get huge valuations in the private equity market. But in the stock market, the companies are valued based on their profits, cash flow, price to earnings ratio, and business growth. And because Zomato is still a startup and it will take years for Zomato to mature into a stable company. So today, the risk in Zomato is very high and the reward in Zomato can also be very high. Because a long time ago, Amazon was also once like Zomato, a loss-making startup burning investors' money for customer acquisition. And when Amazon was listed in the US stock market, many investors saw it as a poor investment, including the greatest investor, Mr. Warren Buffett. In the 2019 annual meeting of Berkshire Hathaway, Warren Buffett said, "I was wrong on Google and too dumb to appreciate Amazon." Warren Buffett admitted that it was a mistake not to buy Amazon years ago, and the stupidity was not to see the potential in Amazon. Because Amazon was a loss-making company for 14 years, and finally in 2001, Amazon recorded their first profit. And from then, people started seeing potential and value in Amazon. So now the question arises, what happened to Amazon years ago? Can the same thing happen to Zomato as well? And what Zomato has to do in order to succeed like Amazon and become the next Amazon of India? So the first thing what Zomato can do is eliminate competition, because Amazon killed its competition by delivering a unique customer experience which no other player in the e-commerce business could do. Zomato can do the same thing by offering something unique that its competitors cannot. And also in future, Zomato can eliminate competition by acquiring Swiggy, which is its only rival in the food delivery business. And also as a contrary or in a parallel universe, it can also happen that Swiggy might end up buying Zomato. And the second thing Zomato can do is ultimately become profitable. So if you see, Zomato has been reeling under the pressure to turn profitable since the day it went public and raised over 9,000 crores from the public. And since its listing, Zomato's investors have seen their wealth decline. And with such expectations and pressure, Zomato cannot keep making losses forever. So Zomato have to find a way to get profitable by improving their business model and changing their business approach to ultimately become profitable. And the third thing what Zomato can possibly do is diversification into other promising businesses. So if you see, Amazon Web Services or AWS is an excellent example of diversification strategy employed by Amazon to secure profitable growth. Zomato is also doing good when it comes to diversification. It already have 5 revenue streams apart from the food delivery business, but Zomato is working on more diversification plans that can help the company become profitable and make its business more stable. For example, Zomato is working on a cloud kitchen concept which will give Zomato a competitive edge, because here Zomato can deliver its own food to a particular set of customers. And if the customers like the food, then next time, discount or no discount, they will still order the same food from Zomato's cloud kitchen, which can help Zomato increase customer loyalty, help reduce cash burn and become profitable. So to conclude, the business of Zomato is risky, but at the same time it is also very promising. So either Zomato will become like Food Panda and will become another case study of how food delivery business can go bankrupt, or Zomato can become successful in the long run and prove all the investors who doubted it, just like Amazon who proved Warren Buffett wrong in the long run. So that's it for today guys. If you learned something from the video, please make sure to hit the like button. This will make YouTube algorithm happy and will help the video to reach as many people as possible. And also to watch such more insightful case studies, please subscribe to our channel. So thank you so much for watching. I will see you in the next video. Until then, this is your friend Bharat Shankar signing off.